All righty, so we are here for session 5 of Chart and Trade. Whoop whoop, we have made it through the basics, right? We went through the basics, we went through charting, we've gone through a week of cash secure puts, we've gone through a week of covered calls. That was week 4. We're on week 5 now, session 5, which is credit spreads. We have a Facebook group where the information is being put in the Facebook group, different trade ideas, different videos to watch, all those good things. Okay. Um, that's open. And if you, hopefully you've joined the Facebook group by now, but the Facebook group is Chart and Trade. And that link was given to you a few times in your emails, the earlier email. So if you haven't joined that Facebook group, you should have, you could go ahead and do a quick little look for it and come on, join us in the Facebook group, right? Okay, let's get going. Credit spreads is our dealio. Okay, today the disclaimer, always got to have a disclaimer, not a solicitation to buy or sell any security. I'm not giving investment advice. I'm not an investment advisor. Stock market is not easy to predict. You can take losses. You will take losses. The goal is to win more than you lose. I'm not responsible for those losses, nor am I responsible for your wins. Everybody takes full responsibility for everything that they do. Okay. Am I sharing my screen? It says I'm sharing. I want to make sure that I am sharing. It says here that I am. So, okay. Thank you, Janae. Vertical credit spreads is what they're called. Vertical credit spreads. Basically with credit spreads, you're entering into a trade with 2 options contracts at the same time. You're entering a buy contract and a sell contract. Up until now, what we've talked about is cash secure puts, was we were selling puts. And covered calls, you were selling calls. You're only doing the one thing. But now when we do spreads, the spread is 2 contracts. You've got a buy contract and a sell contract, and you collect premiums when you enter these trades. When you enter, you collect money, just like with covered calls, just like with cash secure puts, you collect money when you enter as a seller. All right. The benefits of this strategy is that, it's straightforward and fairly simple, just like selling cash secure puts and selling covered calls. There's a little bit more to it, but not a whole lot more. These spreads can be done on any equity, any stock, any ETF, anybody that has options, you can do spreads on those options. And basically you're going to select your strikes above the resistance or below the support, depending on which way we're going. And you can look for consistent profits without using a whole lot of collateral. Remember when we talked about cash secure puts, you had to put up the amount of the strike times 100 shares. So if you had a 15 strike, you had to put up $1,500 of collateral. If you had a 20 strike, you put up $2,000, so on and so forth. If you were doing covered calls, you had to have the 100 shares, or you needed to have a long call that you were selling against. Well, so those 2 things can be a little bit, a little bit pricier. But when we're doing spreads, the cost of these trades is equal to the amount of the spread. And that's going to mean some more to us here in a minute. But okay, let's talk about the 2 types of credit spreads. There are call credit spreads, which are also called bear call spreads. The bear being something that's going down, bear call spreads. This is a bearish strategy. It's a call credit spread. Many of you know, if you start talking about calls, you're believing the price is going to go up. But when you're selling a call, anything, selling a call, covered call, selling a call credit spread, you're expecting the price to go down or at least stay below your strike. Expecting price to stay flat or to go down. It works just like covered calls. We talked about covered calls last week where we were expecting price to stay below a certain strike. Same thing is happening with call credit spreads. Put credit spreads, also called bull put spreads. Bull meaning, bullish, going upwards. You're expecting price to stay flat or to go up. These work just like cash secure puts. So though previous weeks we did just those individual legs, we sold puts, we sold covered calls. Now we're looking at making it into a spread, making these into spreads. So that same thought process for the call credit spread, or the same as covered calls, put credit spreads are very similar to cash secure puts. Let's talk about call credit spreads first. Selling a call credit spreads means that you expect the price to stay below your sales strike. You expect the price to stay below your sales strike. You're entering into the trade as a seller. We're selling credit spreads. That's why it's called credit. It means you're going to take in money. When you're doing anything with a credit, that means you receive the money, right? Your broker is going to reserve collateral in the amount of the width of the spread between these two contracts. So a 1 spread is $100 worth of collateral. A 2.5 spread is $250 worth of collateral. A 5 spread is $500 worth of collateral, which again, that's much less. This $100, we were talking about a 15 spread on a 15 cash secure put and requiring $1,500. Well, if we do a 1 spread on that same stock, then we only have to put up $100. Basically, you're going to get to keep all the premiums if the price is below your sales strike at expiration, just like with covered calls. If the price is below your sales strike at expiration, you're going to keep all the premiums that you received at the beginning of the trade. The difference between the two strikes is called the spread. That's why it's called spreads, because there's two contracts, and the difference between those two is the spread. A 1 spread is worth $100, 0.5 spread, which we do have some of those, are $50 worth of collateral, and a 2.5 spread is $250 of collateral. I mentioned that on the last slide, but that's what that's all about. Okay. Not sure what's going on with that. Okay. Chart your resistance. If you're doing a call credit spread, you're going to chart your resistance on the daily time frame. Select the sell strike above that resistance, either at or above that resistance, and you're going to select the buy strike even above that. So your current price, go up for the sell strike, up for the buy strike when you're selling a call credit spread. You want to decide on an expiration date. Remember, time decay is our friend. So if you're selling for, literally you can enter on Thursday for Friday, you can enter Wednesday for Friday, you can enter Friday for Friday. There are people in this community who trade 0 DTEs. And 0 DTE is basically I'm entering today and it's expiring today, and which is fine. Theta decay or time decay is on our side. It actually helps the trade some, but you definitely have to be even more sure of the zones when you're doing it on 0 DTE. 0 days to expiration. That's what DTE stands for. 0 DTE is 0 days to expiration. 0 days, that should be a 0, not a O. 0 days to expiration. That's what DTE stands for. There's no days until expiration because we're in the same day. You're trading on the same day it's expiring. Okay, so I said here, if you had a current price of 100, if the stock is at a current price of 100, for a call credit spread, you would go up for the sale. You're going to sell a call, for example, at 102. And then you're going to buy a call higher than that, which would be 103. 102, 103. The sale leg is the one that's closest to the current price. The sale contract is the one that's closest to the current price. And then the buy contract is further away. Whether that's 1 spread, you can actually widen it if you want, but you want the sale contract to be closer to the current price, or that's the next one up, basically. Okay, this is a 1 spread because the difference between 103 and 102 is 1. This is called a 1 spread. And in this case, you'd be expecting the price to expire below 102. You want the price to expire below your sale contract. All right, that's for call credit spreads. Let's keep going with that. I don't think those slides are done. How do you win these trades? when you win, or keep all your premiums when the price expires below your sales strike or below that 102. That's when you keep all the premiums. You enter this trade, you get $15, $20, whatever. If the price expires below that sales strike, which in this example was 102, then you get to keep all of the money that you took in premiums. You would suffer what's called max loss if the price is higher than your buy leg or your buy contract. Okay, that's at 103. Remember, we had 102 and 103. If the price expires above 103, then you would suffer max loss. Max loss is the width of the spread. So if it's a one spread, your max loss would be the $100 minus the money they gave you already. So if they gave you money, then it's less than that. So it's really not $100 of loss. They give you part of the money when you take in your premiums, and then if it's max loss, they basically take that money back and then more of your money. If the price expires between your strikes, then you have to pay whatever the trade is worth at expiration. So if it's below the 102, you keep all the premiums. If it's above 103, then you suffer max loss. You lose the whole width of the spread. But if the price expires between 102 and 103, you basically just pay whatever the spread is worth at the time. You lose whatever it's worth at that time. In order to close these trades, we would go to the monitor screen. Now, this is how you do it in Thinkorswim. Some of us have other platforms that we're working with, and if you're doing it on Robinhood, it's a little bit different, but I'll talk through how do we do it on Thinkorswim, then I'll talk through what it does on Robinhood. Okay. Go to the monitor screen. You want to select one leg of the trade, hold the control button and select the other contracts, or the two contracts you want to select them both. Then you right click, select buy. This would have been broke up into pieces. Right click, select buy, and then input the buyback amount into the limit box. Right? Janae says to the more of your money part, you only lose the amount of money that's the width of the spread. You can't lose any more than the width of the spread. So if it's a one spread, that's the most you're going to lose. And you're not even going to lose the whole $100 because the broker is going to give you some money for entering the trade. So the difference between the 100 and what they gave you is what you're going to lose, right? Now let's talk about put credit spreads. That was called credit spreads. Call credit spreads happen above current price, right? You got a current price, you go up for the sale leg, up one more time for the buy contract, open, close, yada, yada. We're going to do one or two examples at the end. If there's questions that pop up along the way, put them into the comments or into the chat. Selling a put credit spread. When you sell a put credit spread, that means you expect the price to stay above your sale strike, just like selling cash secure puts. You want price to stay above. Now, whatever you remember about buying calls and buying puts, this is the opposite of that. So for those of you who only know about buying calls and buying puts, you need to now flip your brain to say this, the exact opposite of that. When you're selling a put, this is a bullish move. You're expecting the price to go up or at least to stay flat, and you want the trade to end above, with price being above your sale strike. That's selling a put credit spread. Not buying a put, selling a put. Okay, you want to chart your support on the daily time frame. Select the sell strike below support, this should say, and select the buy strike below the sell strike. Okay, let me fix that because that'll bother me. If I leave it, it'll bother me. Below support. All righty. You want to decide on your expiration date. And again, remember, theta is our friend. Time decay is our friend. If we're doing weeklies, I like to do, Tuesday or Wednesday. Some of us do Monday. Some people do, I like all the days, to be honest. I'm even going to say, I'm going to say I like one thing or the other. I like them all for different reasons. Because I also like to enter on Friday for the next Friday because you get good premiums that way. And then the weekend helps you with theta decay. Sometimes I like doing it on Wednesday, especially if the stock is very volatile, because that means I only have a couple of days to expose myself to the market for that particular trade. So it really depends on what the stock is and what I'm looking to get out of it. Put credit spread. If the current price is $100, for example, you're going to go down and sell a put contract at 98, and you're going to go down one more time to buy a put contract at 97. Remember, the sell leg needs to be closest to the current price. Sell contract needs to be closest to current price. And then the buy contract is lower than that for a put credit spread. So it's price down, down, price down, down. And you want to put the sell leg between the two, because if you switch that around, that trade becomes a completely different. It becomes a debit spread, which is not the same thing. Not exact, it's the exact opposite. All right, this also is a one spread because the difference between 98 and 97 is 1. And you're expecting the price to stay above 98. You're expecting the price to expire above 98. Okay. Come on, Cletus. The money of the trade. Okay. If you're using a one spread trade, just like the one we just did, the total collateral for the trade is $100. Let's say you receive premiums of $17. $17 is your max profit. When you enter, you say, I'm going to sell this to you for this price. You don't get to change it along the way. So if you receive $17, this is all you're going to get for this trade, this contract. If you want more money, you do more contracts. All right. If you agree to sell it for 17, this is the max profit. You're not making any more money, no matter what the price does. It can run to the moon. You decided on $17, what you're going to get. Okay. The broker is going to block $83 of your buying power. Why $83? That's $100 minus the 17. $100 minus the 17 that they gave you means that your collateral or your deposit, remember last week we were kind of talking about putting your deposit down. Your deposit on this trade per contract is $83. This is your deposit, which is your max loss. Your max loss is that $83. And this happens if the price is through both of your strikes. If the price is through both of your strikes, then you would suffer max loss. We talked about that a few slides back. Okay, we'll do some more examples and drive that home here soon. All right. How do we win these trades? What does winning look like? Well, you win and keep all your premiums when the price expires above your sales strike. So we're talking about put credit spreads. When the price expires above your sales strike, which was 98, then you're going to keep all the premiums that you received. If it was that $17, you're going to keep the whole $17. You suffer max loss if the price is lower than your buy leg at expiration. So if your buy leg is 97, price expires below 97, then you're going to suffer max loss. And max loss in that example was $83. The amount of money you're going to lose is $83. And if price expires between your strikes, you're going to basically have to pay whatever it's worth. Depending on where it is, it may be, just a few dollars. You may break even because there's a little bit of room for a break even, right? But that's how that works. You win it when the price is above your strike. Max loss if it's below your buy strike, and it's somewhere in the middle if the price ends in the middle. So how can we avoid max loss then? We can avoid max loss by having A couple ways, really. I didn't even really put on this one. One way you can try to avoid max loss is making sure that you've done good charting and you're comfortable with the strikes that you selected. Right? You want to select strikes that are beyond support, beyond resistance. Of course, the market and any stock can do what it wants to do on any given day. So you try to be as safe as possible, but you can't be but so safe because if you move too far away from current price, there's no premiums there. So it has to be a nice little dance between where am I picking my safe strikes and where am I going to get the money I want. Because we're not trading just to trade, we're trading for money. So you don't want to say I'm trading and you take in $1, $2, or $3. Well, that doesn't buy you anything. You're gonna pay $2 or $3 in fees. So you might as well not even be doing it, right? So you want to take in as much money as you'd like to, good reasonable amount of money in your premiums while not being too close to the fire. You want to be, close enough to get some premiums, but not so close that you get burned. In addition to that, you can have yourself a predetermined stop loss. And a stop loss basically is the value of the trade at which you're going to close it for a smaller loss. For example, if you receive $15, you might consider using 0.45 as your stop loss. This is what I call a 3x. That's because it's 3 times 15. This is a 3x of the premiums that you took in. This means you'd suffer a $30 loss versus letting it do the whole thing and you end up with an $85 loss, because if if it got breached through both of those, then you would suffer max loss, which would be $85. So you want to have some type of stop loss plan in your mind. What do I want as a stop loss? Be sure to select strikes you feel safe with, even if you take in less premiums. You don't want to go so far away or be so safe that there's no money, but you don't want to go so close just based on premiums. You want to have a nice, comfortable place between those two where you feel like, yes, I'm getting some kind of good returns for myself, but I'm also not too close. Not too close, not too far. And how do we trade these? We go to the monitor screen, select the one leg, hold the control, select the other, select buy. You can input the buyback amount or you can just let it feel because it will populate on its own. But if there's something you like, if it's worth $15 when you enter and you're fine with closing it at $2 or $3, you can put that in the limit box and let that work on its own. Or you can just, whenever it's ready, you can select all these close things and then whatever populates, you can close it there. The whole point is that you want to close it. If you're going to close it, because you can't let these expire on their own, but if you're going to close it, you want to close it for less than what you took in. So if you received $15, you want to close it for, 10 and 5 and 2 and 1. You want to close it for less than what you took in, because as a seller, we sell high and we buy back low. You sell high, you sell for that $17, and then you want to buy it back when it's down worth $1 or $2 or $3. And the difference between those two is your money. Just like we talked about with cash secure puts and covered calls. Right? You take in an amount at the beginning, and then you want to close it for less than that when it's time to go. Okay. I don't see any questions popping up in the chat. I don't know if that means we're understanding well or that means we're not understanding at all. I don't understand nothing you talking about. Not a thing. All right. Let's do this. Let me go ahead and ask the question. If what I've said made good sense, put in a 1. If what I said made some sense, put in a 2. And if what I've said has made absolutely no sense, put in a 3. I see some 1s, I see some 2s. Okay. All righty. I'm looking at SoFi. SoFi has been on the move a little bit. It can't seem to get across that $16 mark though. Can't seem to get across $16. Okay, let's talk about first. Let's look at a put credit spread. Let's look at a put credit spread. Okay, put credit spread, which is it bullish or bearish? You just multiply by that 20. So 20, 40, 60. Okay. Selling a put credit spread is bullish. We're going up. It's a bullish trade. So here we need to chart the support. We need to chart support is our first move. Hope everybody can see that pretty good. I don't know how to make this box any bigger. We're going to chart support, which I think I've got a little piece of it here. Support on the daily. I'm on the daily part of the chart. See this big old D up here? Let's see if I can make this stuff any bigger. Application settings. Look and feel. Very large. I don't know if that changes. Oh, there we go. It didn't really change the look of this this text box, but cancel. I want you. I want you, baby. Okay. We're charting our support, which I got us right here. Let's move you again because now you're in the way. I got support down here at 15.28. Remember, we're starting at current price and going down to the pivot place or the place where it turns around. So I got support at 15.28, which means we want to find a strike below 15.28. We want to find a strike below 15.28. To find a strike below 15.28. Okay. Looking, now we're going to the trade. Gonna put this on a single life. This is the put side. Let me get my pencil ready so I can draw some stuff. We're on the puts side. We're doing a put credit spread. So we're on the puts side. And we're looking for a strike below 15.28. Now, it's Thursday, right? So the next expiration would be tomorrow. So we're a little close to do it for tomorrow. The 15 strike looks like it's paying $2. That would not be worth it at all. And you can't even enter it till tomorrow anyway. And that will make it a 0 DTE, which that's definitely an option of yours. If you open and close a trade the same day, if you manually open and close it, they're going to charge you a day trade. If you manually open it but let it close on its own, they won't charge you a day trade, but that means you're kind of at the mercy of whatever happens, right? Let's not do the 13th. Let's look forward to the 20th. We're going to look on the 20th of December so we can see. We're going to look at the 20th of December. We're still going to look for our 15 strike. I have way too many those strikes here. This is too many. 50 is too many because it makes it all crowded out here. But anyway, this is the 15 strike. We're looking at the bid column. Bid column is for sellers. This is the sellers column, is the bid column. If you're somebody who buys calls and puts, you probably go to the ask, but we're sellers, so we go to the bid. And some of y'all probably even know what's this over here for? It's for us sellers, okay? We're looking at the at the strike that's going to be the one for us. Now, quickly, we'll talk about the probability of being out of the money. I won't really go too deep into that, but we do, when you're a seller, you want to be OTM, which is out of the money. OTM is out of the money. OTM, out of the money. That's what you want to be. I'm not sure why that keeps putting me there. That's where you want to be, is you want to be out of the money when you're a seller. When you're a buyer, you want to be in the money. When you're a seller, you want to be out of the money. So this is a good, we like this strike. 15 is a good strike here. It's below support, but now it's on single, and we don't need it on single. We need this on a vertical because we're doing a vertical. Works a little bit different on Robinhood. I'll talk through that here in a minute. But single, where it says spread, we want to be on vertical. See, it says single, then it says vertical. We want to be on a vertical because we're doing a vertical credit spread. Okay. Let me see. Nope, that's not what I wanted. Sorry. I did not mean to pause screen. Okay. We wanted the 15 strike, and we want to be on the put side. So we're looking for 15 on this side of the bar. We're looking for 15 on this side. Remember, that was the strike we said we liked, was that 15 strike. That's what we like. So we're going for 15 on this side. It's going to automatically give us whatever the regular spread amount is for SoFi. It's a 50-cent spread. How do we get 50 cents? But the difference between 14.5 and 15 is 50 cents. 0.50 is the difference between those two strikes, which is called a 50-cent spread. It's a 50-cent spread because it's only 50 cents between these two. Between those two strikes, it's only 50 cents. 50 cents means you're going to take in $9, 0.09 times 100 shares. Okay. Well, anyway, so we want this 50-cent spread, and this amount of money is 0.09. So if we were to click on the bid column, it actually comes up with a little more money for us. It says that you're going to take in $10. You're going to take in $10 for this spread. Let me get us, okay, this is the amount of premiums you're taking in. Where are we? I need my pen. Here we go. Okay, 50-cent spread. How much collateral is being used on a 50-cent spread? Yep, $50. A 50-cent spread is $50, 0.50 times 100, $50. Minus the $10 that they're giving you in premiums. This $10 is what's here. We're subtracting that $10, which means the broker is going to block away $40, like your deposit. It's going to block away $40 of your buying power. Okay? $40 of your buying power, like your deposit. That's what the broker is going to block away while you're in this trade for each contract that you're in. The question in the comments was, can you widen the spread? Yes, you can. So where I see where it came up automatically as a 14 at 14.5 and 15, you can decide, okay, 15 was the sale strike. Notice this has -1 here. -1 means we're selling. This whole thing is red, which means you're selling. This is all that look, and you see the word credit right here, which means you're going to take in money. 15 was the strike that we wanted for our sale strike. We need to go down lower than that. Remember, we went from the sale strike closest to current price, and then you go down and down. So I made it now. I made it into a one spread, right? 14, 15 is a one spread now. Once we're in a one spread, my annotation. How much collateral are we looking for now? A one spread is how much? A one spread is $100. Yes, that's $100, right? Minus the $16 that they're going to give you in premiums. Minus this $16 means that your buying power is affected by $84 of buying power, like your deposit. Okay, yep, I see it's clicking already. All righty, if we pick this trade, let's say we go into this trade. When, W-H-E-N, do we win, W-I-N, this trade? When do we win? Where does price need to be for us to win this trade? Where does price need to expire for us to win this trade and keep all of our $16? I see some answers popping in. Price needs to be above 15 in order for us to win this trade. Above 15. 15 was our sell strike. We need the price to be above 15. Okay. If the price is below 14, what if the price closes below 14? What does that mean for us? If the price closes below 14, what does that mean for us? That's max loss. And we lose, as Shanna says, we lose the $84. Yep, we lose the $84 if then. And if it's between 14 and 15, then it's worth somewhere between $0 and $84. It depends on where it is and what the value of the trade is at the time. And that's not something, it's not like an easy one for one. It really depends on the time, depends on the implied volatility. It's got a lot of different factors. So you can't just flat out say, if it is 25 cents between, then you pay $25. You can't, that's not the way that works, okay? All righty. This was SoFi looking for the 20th of December, which would be next Friday, 14-15 spread, a put credit spread. You see the word credit here. If you like all the stuff that said, you can push confirm and send. Then it pops up and tells you what actually is going on in the trade. If you're looking at Thinkorswim, Thinkorswim will give you all this good old information about it. It says, yep, you're going to take in $16 is your max profit. Shows here $16 is your max profit. $84 is your max loss. Okay, the cost of the trade, you're going to get a credit of $16 minus the money that you're going to cost you for your fees. Buying power effect means the broker is going to block off 84 of your dollars. And, you know, in your regular account, it'll tell you how much money you got left to do stuff with. Okay, and when you're okay with that, you push send. Okay, I need my mouse back. Okay. Will we be assigned? So if your account is big enough to withstand or to hold 100 shares, you could be assigned. If your account is big enough to withhold 100 shares at $15, then you could be assigned. So if you got at least $1,500 of available money, you could be assigned. If you do not have $1,500 of available money, then what would happen is the broker will then sell the buy leg. Basically, they'll exercise the other side, and then then you will experience max loss. So if you're breached completely and you get assigned and your account can hold $1,500, they will give you 100 shares. If you are breached and your account cannot hold $1,500, not have $1,500 free, then the broker is going to exercise the 14 strike and your max loss will just be the $84. So either you'll end up losing the $84 or you'll have some shares of SoFi at $15 a piece. Many times people have bigger, they're trading on something that's bigger. So if you're trading on something like a Tesla that's 400 and something dollars, right? Then unless your account can hold, let's say you pick the 395 strike, if your account can hold $39,500, then you have to worry about assignment. Otherwise, you would just lose the 250 because this is a 2.5 spread. Okay, one of the ones people trade a lot is Triple Q. So let's go take a look at it. I'm going to do a call credit spread on this one. We did a put credit spread on that one, which I wouldn't necessarily suggest a call credit spread on SPY and Triple Q just yet. They seem to be trying to go up a bit, but it does have a sell zone or a resistance area. So we will look at it. Good thing about Triple Q and the SPY and those is that they're one DTE. You can do the next day or a couple days later. They've got more expirations you can choose from. Of course, you can always choose to do the daily, same day expiration, next day or next day, really up to you. Okay, let's look at Triple Q and we're going to look at it as a call credit spread. Okay, question. Call credit spread, is this bearish or bullish? Call credit spread, bearish or bullish? Oh, thank you, Brandon. Brandon gave us a little bear as one of the icons. It's bearish. Call credit spread is a bearish trade, Elisa, and we're expecting price to go down. It's a call credit spread, which is much like covered calls. Expecting price to at least either go down or stay below your strike. Expecting price to go down or at least stay below your sell strike. Okay. Now we need to first chart the resistance. Need to first chart resistance. Our resistance is up here at this point, the high 529.88. Popped up here, closed and left a gap that still needs to be filled. Charting the resistance. Above 530.61, somewhere up there. What do y'all think we should put our strike? What do y'all think we should put our strike? Select the strike above 530.61. Let's look at our 532, 534, 531. Yep, somewhere above 530. All those sound good, right? So today is over. Today's the 12th. 13th is tomorrow. We're not going to do the 13th. So let's maybe we look at what Monday would hold for us. Something else you can look at is probability out of the money. We just talked about that a little bit. You want to be out of the money and the probability of being out of the money. That's what this prob OTM is. It's the probability of being out of the money. Nope, I don't want you. Probability of being out of the money right here. You want a high enough probability. This is a 75% chance of being out of the money. 80% chance. 75, 80, these are good places. 90% chance is great, but the money is not as great. Okay, so you have to remember what I was talking about, the nice little balance. 90% is at 535, maybe a little further away, and you're like, oh, that's like 9 points away from current price. Probably not going to be much premium 9 points away. Okay, so somewhere between 75, 80, somewhere in here generally is safe. Generally, nothing's ever everything. Generally safe. All right, so I looked at 532 or 533. Let's look at these two to see what kind of premiums we get when we turn it to vertical. Go from single to vertical. If we were looking at 532, now we're looking on the call side. We're on the calls side and we're looking for a number, our number 532 or 533 on the call side. We want either this one or this one. This is where 532. Notice there's a 532 over here on the put side. That's not the one we want. We want the one that's on the call side. We don't want the one on the put side because we're not doing puts right now. We're selling calls. We're doing a call credit spread. So we want to be on the call side and we're looking at the bid column because the bid column is for sellers. The bid column is for sellers. 532, 532, 533. The sellers column is that this is a, what is this? What spread is this? One spread, two spread, three spread. What is it? From 532 to 533, how much of a spread is that? Yep, that's a one spread. It's a one spread, which means it will take about how much money in premiums? It will take $100, not in premium, collateral. Take $100 in collateral minus what we take in premiums. Okay. Notice 532, 533. When I click on this for Monday, it's paying $13. We clicked on that. It's paying $13. Erasing some of this stuff so we can see. But what? Now, this was the 532, 533 paying $13. But 533, 534, we click on it, it's paying $11. So both of them pay, decent. Both of them pay decent. You just have to say which one are you more comfortable with. We talked about the 532 strike had a 75% probability out of the money, and a 533 strike had an 81%. This number, when I was looking at these numbers, this is dynamic when the market is open. This probability out of the money and this delta, these numbers are fluid. They change depending on what price action is doing. So if you looked at, 8, 9:30, 10 o'clock in the morning, it might have one number. You looked at 1 o'clock in the afternoon, the number may be different. So it really depends on when you're looking. You're comparing you're working with your chart and you're looking at your delta and probability out of the money. This number doesn't stay here, right? It changes with price action. So just because it says 75% now doesn't mean that at 10 o'clock tomorrow morning, it's going to still say 75%. All right. You want to, when you're getting ready to look and get into your trade, you want to check these numbers on your own. This is an, I guess it puts, it falls under one of these, I don't even see it now. Oh, right here. When you're on your, on this option chain, you can select this for under custom and you can pick what column set. You can pick what you want to put in your columns. And I picked probability OTM. There's probability ITM. There's the delta, volume, there's all the stuff, a whole slew of things to pick. So if I went customize, see all these things over here, you can pick all kinds of stuff to put on your option chain. And, the more things you put on here, the less room you have to see everything. So I try to keep the least amount of stuff on mine as possible because too many things are distracting. All right. That was that. Okay, so let's go back to 532, 533. Taking in $13 in premiums. 13, both of them is 100, Carolyn, because if it's a one spread, the spread between the two strikes, the amount between the two strikes is called the spread. So the difference between these two, where are you? My pencil. There you go. The difference between these two is 1. The difference between these two numbers is 1. So that's where our one spread, which is $100, comes into play. We're going to take in $13 in premiums. Okay, we've got the sale leg of 532, the buy contract of 533. Okay, where does price need to expire in order for this to be a successful, a totally successful trade? This is a call credit spread we're talking about, call credit spread. And we've got 532, 533. I see below strike, below which strike? Below 532. Yes, it has to be below 532 in order for you to keep your whole premiums. Okay. What happens if the price expires above 533? If price is greater than 533, what happens? Max loss. Max loss is how much? No bueno. This is true. Max loss in this case is $87 because that's 100 minus the 13 that you take in premiums. All righty, the broker is going to block away $87 of your buying power while this trade is going for each contract. If you do more contracts, you just can multiply these numbers by the number of contracts that you do. These trades can be closed at any time. You don't have to wait till expiration to close them. If this opens up, if Triple Q opens on that day, the price falls down, and then the value of this trade gets to be worth less than what you're ready to close it for. Maybe you want to close it for $1 or $2 or $3. You want to close it for that, you can close the trade whenever you want. You can close it. If it's higher than 13, you can close it. If it's lower than 13, you can close it. Of course, your desire is that you want to close it when the trade is under $13 because that's profits for you. But this is where we talked about though that max loss, right? If you got $13 and you want to talk about your stop loss, not a max loss, you want to talk about stop loss. Remember, I talked about using 3x or 2x for your stop loss. If you take 13, multiply that times 3, right? This gives you 0.39. So you can say, if this trade gets to be worth 0.39, then I'm going to close it. That could be your stop loss. You can say, I want to do a 2x or a 3x. And I do 3x, 3 times what you took in. If you take in $39, you say if you take in 13 and it gets to 13, say, well, if it gets to 13, I'm going to close it. That means you've got a $26 loss versus max loss. But you want to have thought about what is your place for loss? What is your stop loss idea before you enter these trades? What is your stop loss idea? Okay, I'm going to show you one more. Here we go. Let's look at, maybe I'm going to look at Tesla, but let's look at one more thing. Look at something different. Microsoft this week was supposed to be on the Iron Condor list, even though it's looking like it definitely got bullish. Did anybody trade Microsoft this week? Any of my folks trade Microsoft this week? It's not looking very neutral right now, is it? I know our list said that it was neutral, but it's not looking very neutral. Melissa said, no, it took off. Yeah, I see. It took off. Sometimes you have a stock that is kind of trading in a zone, and you could look at a call credit spread and a put credit spread in conjunction, and that is called an iron condor. An iron condor is where you do a call credit spread and a put credit spread at the same time. So you can say, I want to be above 18, I'll do a call credit spread. And maybe below 16, I'll do a put credit spread. Okay, maybe you say not 18, 18 is a little close. Maybe you do 19, 20 on a call credit spread, and you do 15, 16 on the put credit spread. These together, it's called an iron condor. Y'all might have heard me or seen me say stuff about iron condors before. An iron condor, and I'm writing with my mouse, which is why it's writing so crazy. Okay. In this case, you want the price to end between 16 and 19. You want price to close somewhere between 16 and 19. The good thing about iron condors is, let's say on this side, you get, $12 in your premiums. And then in this trade, you get another, let's say we get $11 down here. Iron condor means that you're taking in premiums, you're taking in this full premium amount. And these are one spreads, so you're using $77 of collateral. So you're getting double the premiums, but you're not having to use double the collateral. You're getting money on both sides, but you don't have to put up $100 on both sides. You only have to put up the $100 one time, because the price can't be at 19 and be at 16 at the same time. And the broker knows this, so they only charge you the buying power one time, because the price can't be in two places at once. That's called an iron condor, and it's usually used like this when the stock is like between a place where it's kind of consolidating and not going up as fast as like that Microsoft or Tesla or whatever is just running, or Triple Q and SPY, the ones that are running. This is not doing that. And because it's kind of staying inside of a zone, an iron condor could work better for those. You want something that's neutral. You want a neutral stock to do iron condors on. All right. What questions do we have? What questions do we have? I think Apple is a 2.5 spread now. It is. Yep, a lot of things are 2.5. SPY, Triple Q, those guys are all one spreads. IWM is a one spread. Yep, I can, Mama Net. iPhone War said, you mean like stuck in a rut? Yeah, if it's stuck in like in a channel, if it's in some kind of channel that's not going up or down. It's just kind of going up and down a little bit. Okay. I'll still use this one. Iron condor is when you do a call credit spread and a put credit spread. So you do a call credit spread, and they don't have to be entered at the same time, but it's when you do a call credit spread and a put credit spread. Yes, 2.5 is 250 bucks total. Mine is, but you get better premiums. So you'll see that when you do a 2.5 spread, you should take in better premiums. So let's say we wanted to do a call credit spread, a CCS, and we wanted to do 19 as our sell leg and 20 as our buy leg, and we take in, I'll still use our $12 again. You get in $12 in premiums. Okay, you take in $12 in premiums. You can also do, you probably don't have to go as low as this, but for the sake of this example, you can also do a put credit spread, and maybe you do that at 15, 16 put credit spread, and let's say you take in $11 in premiums. Okay, these don't have to be entered at the same time, but if the both trades are going at the same time, it is called an iron condor. It's when you put the call credit spread and the put credit spread together. You take in a total of the $23. You add these two together, you take in a total of $23, but you only use one spread, right? This is a one spread, this is a one spread, this is a one spread. But because price can't be up here, can't be at 19 and be at 16 at the same time, at expiration time, the broker knows this. So the broker only charges one set of collateral. So if you are receiving $23 in premium, then your buying power impact is $77, which basically is 100 minus 23. It doesn't even have to be the same expiration date. If they're going at the same time, while they're on at the same time, then they're using the same collateral. But if they're staggered, then after one is closed and the other one is still going, it's still going to block up the buying power. So if you got one for this Friday and one for next Friday, when they're both going, you're only using the $100. But when that first one closes, the $100 is still going to be there because the other one now needs the collateral. Right? They don't have to be the same expiration date. You can have different expiration dates and still be called an iron condor. Okay, so that's $77 of collateral, or your buying power is what your deposit, as it were. That's going to be what you do with that. Now, if you're doing Robinhood, you're going to have to you have to select your legs separately when you're doing Robinhood. You have to then say, okay, I want, let's say that 1920. You'd have to go to Robinhood and do sell a call. You have to pick at the top, sell a call at 19. Then you change the toggle to buy, leave the call there, and then you pick the 20. They also have something in Robinhood called a trade builder. You can pick that builder and tell it you want to do not an iron condor. Tell it you want to do a call credit spread, and Robinhood will walk you through the picking of the strikes if you're going to do a trade builder, which is probably the safest thing to do in Robinhood instead of picking your strikes individually, is to use that trade builder. All right, for those who use Robinhood.
Alyssa,
all right.
Can you please clarify what you just said about iron condors not having to have different expiration dates? Because last I checked, they have to have the same expiration date to be considered an iron condor. You can roll and do other stuff to it, but the same expiration date for the call credit spread and put credit spread is what makes it an iron condor, I thought.
It is, but if they're going at the same time, the expiration date doesn't have to be the same if they're going at the same time. Just okay, so if one is going to end on the 13th, let's say. Okay, so let me turn my share back on so I can, because I need to be able to write stuff down. I'm a visual learner, in case y'all weren't too clear on that. I like to see it. Okay, so if we had let's say we've got one trade, maybe the call credit spread is going and it's going to expire tomorrow. Let's say it's expiring on 12/13. But we have the put credit spread and it expires on 12/20. Maybe it's expiring next Friday, right? While we're going up to the 13th, these both together are using that $100. They're together jointly using the $100. Once the 13th passes, which will be tomorrow, this trade will fall off, but that $100 is still going to stay because this trade still needs that $100. Okay. It is an iron condor anytime you have, because they're running like concurrently, even though one has a little further out expiration date, it's still functioning like an iron condor. And as long as there's one of them, then, I mean, as long as you got, they're not at the exact same place, obviously, then you've got that one set of buying power that's being used. But once one trade ends, that buying power will still be kept for the other one. I hope I've made that more clear. Okay. Alrighty, so we've covered put credit spreads. We covered call credit spreads and we covered iron condors. Alrighty. This is the strategy that we're going to use for our small account growth accelerator. This is the strategy we will use for that. So if you are going to join us with our small account growth, then you're going to need to lean in right here. You're leaning in. Now, I gave a full put credit spread video and a full call credit spread video are in the Facebook group, and I sent them via email. So you got a full video on put credit spreads and call credit spreads. And when I say full, they're an hour and some change. So it's a full training, right? So you watch those. They were just given to you, right? So watch them if you're interested in making sure you can join us. If you're going to join us for the small account, consider joining us for the small account growth accelerator inside the membership. So that means you're going to need to join the membership if you're going to ride with us, okay? Whoop, whoop. You riding with us. All right. So I'm getting ready to close this off. If you are in the membership or in VIP, I will see you over there in about 5 minutes. Everybody has the link to get where we're going. All right. I see you, Carolyn. Well, I'll be over there in about 5 minutes. Carolyn said she got her grant set aside because she's ready to join up and run with it. I'm with her. Okay. I'll see you all there. Goodbye, Ricky. I'll see you all there in 5 minutes. Those who are VIP or in the membership, I will see y'all there in about 5 minutos. 5 minutos. Goodbye, everyone. It's been wonderful, wonderful. Please go watch those videos. So when I'm putting stuff into the group, the Facebook group, you're not looking at that going, what is she talking about? You'll know what I'm talking about. All right? All righty. All righty, everybody. We'll see y'all later. Bye-bye. Oh, don't forget, tomorrow morning, we're live on YouTube at 9:20. Tomorrow morning, we're live on YouTube at 9:20. All right. Goodbye, everyone.